Good morning, children. Today I am here to discuss with you the lesson Money and Credit from your economics textbook, chapter 3, Money and Credit. This is a common thing, is it not? Money and credit. What is it? How does it help us or anybody? That is what we are going to discuss in today's lesson. Now, I am going to define these two words, money and credit. We are going to define these two words, money and credit. Money is an owned valuable possession of an individual. An owned valuable possession of an individual. Whereas credit is an earned valuable possession of an individual. Did you get the difference between the two? Money, owned valuable possession of an individual. Credit, an earned valuable possession of an individual. Related to economics. Okay? Now we will see what economists say about money. What according to them is money. Money is defined in terms of the functions or services it provides. It provides various functions, it provides various services. So, based on the functions and services, economists have defined money. So, they say money acts as a medium of exchange. It acts as a medium of exchange for what? To facilitate or to aid and support transactions, exchange, transactions. It acts as a medium of exchange to facilitate transactions. Without money, exchange of goods or services is not possible or cannot be easily done. Exchange of goods and services between persons cannot be easily done without using money. So, this is why in earlier days, when we did not have money in circulation, there existed a method called or a phenomenon called double coincidence of wants. That is, without using money, exchange of goods or services had to take place, where the transacting parties, the persons who wish to exchange goods or services, should have what each other wants or each of them desires, what each of them desires or what each of them wants. So, what happens? They will, before they go for exchange or they go for transaction, they will have to find a person who will be able to give him what he needs. The other person will also be looking for somebody who will be able to give him what he needs. So, both the parties should have what each other wants, and only between A and B transaction can happen. So, this will create a lot of practical difficulties. When money came into circulation, money eliminated this phenomenon of double coincidence of wants. There's double coincidence of wants. That is, finding persons who had what I want, what you want, or what he wants and what I want together should come. Only then transaction or exchange can happen. Otherwise not. So, when money came into circulation, this took away this phenomenon, double coincidence of wants. How? By serving as or acting as a medium of exchange. By serving or acting as a medium of exchange. That is, this money is accepted in all transactions, regardless of having what each other wants. It doesn't matter whether I have what you need, whether you have what I need. It is just enough that you have money enough to pay for what he is ready to give you, and he has enough money to pay for what I am ready to give him. So, exchange of goods or services takes place using money, where it acts as a medium of exchange. So, money serves as a medium of exchange. Then, to do what? To help or aid, to facilitate transactions. Next is money holds value. You have some money with it. It's not when it is not just what you need or what is enough you have. You may have extra. So, that money you keep for a long period of time. Even then that money is valuable. It will have some value, good value. So, money holds value, does not lose its value. Then, third one is a common measure. You use the same money to exchange any good or to take any services. It is not said anywhere that money will give you only A, B, C and D. Only money can give you services like P, Q and R. A to Z, anything you want will be available to you if you have money with you. So, money provides what? A common measure. Common measure of what? Of the value of goods and services that is being exchanged. A unit of measuring. A kilo of something, a fruit, has a particular cost. A kilo of something else, a vegetable, has another cost. So, the service somebody provides you the banking facilities. You pay a service charge. Is it not? Yes. So, all this is measured on the basis of what? Measured on the money that you have. So, money acts as a common measure of the value of goods and services that is being exchanged. So, now all this, when it serves as a medium of exchange, it holding value over time and being a common measure of value of all what is being exchanged. What is there? It tells us how money can make exchange of goods easier. By acting as a medium of exchange, by having value of its own, being a common measure of what is being exchanged, money helps exchange of goods easier or makes it easier. Clear? Yes. So, money is what? Something that serves as a medium of exchange, which holds value and which is a common measure of all what is being, measure of value of all what is being exchanged. The next topic is modern forms of money. Modern forms, I told you in the ancient times money was not in circulation. That is why we had the barter system, where the phenomenon of double coincidence of wants existed. You have to find somebody who is able to give us what I need, and I will have to find somebody who will be able to give what they want. Is it not? If what I want should be got for me, what they need should be got from me. Only then I can exchange. So, that is very difficult. So, because there was no money in circulation in the ancient times, the barter system, where exchange of goods and goods or goods for goods, services for services happened, which brought in this double coincidence of wants, and when money came into circulation, all that was wiped off and it could be used for any kind of transactions because of its three features. Now, the modern forms of money, how will we keep money? How will people hold money with them? Either they can keep it as notes, currency, notes and coins. One form of holding money is either as currency notes or as coins. And you know, the paper with which this money is made or the metal with which this coin is made is not very valuable. It's not of a very precious metal. But still this money has got value. Even though it does not have a value of its own, when it is being used to exchange goods or services, it has some kind of value. When it is being accepted as a medium of exchange, it holds value. It gets its value. Is it not? When you keep it somewhere unused, in a suitcase or in a safe box, it has no value, isn't it? But when that money is taken out and is being used for exchanging something for useful purposes, then that money with you becomes valuable for you. So, it is not what it is made of that makes it value, but being used to serve purposes, it gives value to that currency note or coins. Now, also this currency note is authorized by the government of India for all kinds of transactions. It becomes valuable, not only it is being used to serve your purposes, to satisfy your needs, to get something that we need. Also, it is a mode of transaction which is authorized by our government. Transactions can be made by the money, and that currency note or coins which we are allowed to use in our country is being issued by our central government, the Reserve Bank of India. Our central bank, the Reserve Bank of India, on behalf of the government. Nobody other than, no organization, no individual other than the Reserve Bank of India can issue coins or currency notes. Then, as per Indian law, no other individual or organizations can make currency or issue currency, and by law Indian money is accepted for any kind of transactions. It has got a legal value as a medium of payment or mode of payment, and no Indian can refuse to accept any payments made in rupees, because that is a legal money for the country, a legally accepted money for the country, Indian rupee. So, any transactions made within the country cannot be refused by any Indian. The other form in which people hold money is as deposits, as bank deposits, to be more specific, as bank deposits. So, people will be having some extra cash with them. What does he do? Instead of keeping it at home with him, he takes it to the bank and deposits that extra cash with the bank. How is it being done? The bank requests him to open an account in his name with the bank. And in that bank, this money is safely deposited. Underline, safely deposited. Because at home, it is safe, but still we have some kind of doubt of fear about its safety. But we feel that our money is much safer when it is being deposited in the banks. I repeatedly say, safely deposited in bank accounts in our name. So, the banks readily accept this deposit from the person, and the bank pays an amount as interest. I have given my money to the bank to be safely kept there. So, when they accept it, they pay an interest on it. Understood? That we will know why they pay an interest. They are using this money for some other thing. They don't keep that money idle. They are using it for something. So, because we are giving that money to the bank, and the bank is able to use it for something else, they are paying us an interest on it. So, now our money is in safe custody. We get an interest. So, what happens to the money that we have deposited? It keeps growing, isn't it? Plus, plus, plus. I deposited 5 lakhs, I got an interest, 5 lakh plus that interest. After some time, again another amount of interest comes. So, that is what is the procedure of the banks. So, our money keeps growing. Then, it is in safe custody. So, but this money, some unusual situation came to us, and we need that deposit, or we need maybe not the full amount, some money from what we have deposited with the bank. We are allowed to withdraw what we need when we need from these deposits that we have given or that we have kept with the banks. Understood? when we need, what we need can be withdrawn from our deposit with the bank. Since on demand the money as deposit with the bank is withdrawn or is allowed to be withdrawn by us, those bank deposits are called as demand deposits. Deposits or money that can be withdrawn on demand, they are called as demand deposits. How can we withdraw the money? We can withdraw the money using a check. All of you must have seen a check. On page 41 in your textbook, there is a picture of a check leaf. We take one from a book containing a many number of leaves. You take one out, there will be certain columns to be filled. Pay to whom do you want to pay this money? Next column is how much you want to pay. That has to be written both in words and in figures. And then lastly, the most important thing is that I or you have to sign the check before I take it to the bank. My signature, if it is the account is in my name, the check has to be signed by me. Understood? So all this is being done and the check is taken to the bank. So what is that check? It is simply a paper. A check is simply a paper, but it is important. How does it become important? That paper instructs what? Gives instruction to the bank what? That the money specified on the bank has to be paid to the person in whose name the check is written. Understood? From my account, whatever I have written, say 1000 rupees, the bank has to pay 1000 rupees to the person B whose name is there, paid to whoever it is. So a check is a paper which instructs the banks to pay the specified amount from my account to the person in whose name the check has been issued. Yes, on page 41 you can see one. So here, so on demand using a check, the money is being withdrawn, and that is why it is called as demand deposits. So what are the advantages of demand deposits? It is in safe custody. Since interest is paid, it grows. 3, it can be withdrawn on demand using a check. Understood? And when we use a check, what is happening there? No real money is exchanged. But what is exchanged? From one account to the other account. Or if you want money, of course, money will be given to you also. But we usually use this to avoid transactions in terms of money. Cashless transactions are possible using checks. So it's being in safe custody, the money grows, transactions are easily possible using these demand deposits. These are the advantages of having a deposit in your name with the bank. So this helps easy direct settlement of payments. Is it not? Directly that payment is being settled. The person who needs money takes it to the bank and the bank immediately pays it. So directly, very quickly and easily payment has been made. So, and there how cashless transactions, and since they are accepted as a means of payment, since demand deposits is accepted as a means of payment, they constitute money. They take the place of money in modern economy. They take the place of money in modern economy. Understood? What is money? How money is kept with us? How it becomes good? Understood? Yes. These deposits are called demand deposits, I said, because they can be withdrawn on demand using a check. And this money, since it helps payment of or transactions in terms of money, hidden money, they constitute money in modern economy. So, currency and deposits are closely linked to the working of modern banking system, is it not? You have kept it as a deposit, that deposit takes the place of money. So, currency, you are depositing it in currency, deposits and currency are closely linked to the working of modern banking system. Now, what does the bank do with all these deposits? There are many number of people who come to the bank and deposit their extra cash. Understood? So, the bank, what do? The bank try to keep a small percentage of this money or this cash that reaches the banks to pay back the depositor. To pay back the depositor when he comes asking for it. We do not know when a depositor can come asking for money. We do not know how much money he will ask for. So, the bank keeps a percentage, a share of that deposit, of the total deposits with the bank, and the rest is being given out to the needy people as credit or loans. There are many other people. Remember I said, earned valuable possession, is it not? So, what happens? There are people outside who do not have enough money to serve their purposes or needs. So, these people, what do? They come to the bank asking or requesting for money. So, whatever deposits the bank has with them, a part of it is being used to help these people who are in need of money. And the money that is given by the bank to these people can be called as credit or loan. Why? They have to repay it back to the government after some period of time. Understood? Yes. So, the banks keep only a small part of these deposits for themselves and in order to pay the deposits, and the rest is paid out as credit to those who need money. So, what do? So, what role do they act? What role does the bank play here? They act as a mediator. Between whom and whom? Between the depositors who have surplus cash with them and the borrowers who needs money. So, the banks act as a mediator between the two kinds of people, the depositors who have surplus cash and the borrowers who are in need of money. Is it clear? Yes. So, what do you mean by the loan activities? That is the deposits with the bank. They divide it. A share kept apart to be paid back to the depositors when they ask for. The other part is being used to help those people who need money. So, the person who deposits money with the bank is called as the depositor. The person who comes to the bank in need of money is called as the borrower. So, the bank, what is the role of the bank? The bank acts as a mediator. Between whom and whom? Between the depositor and the borrower. Between the depositor and the borrower. And what happens now? In the beginning, when I told you about the deposits made by people with the bank, an interest is paid to the depositor. That is how the money grew. That is how the money grew, increased in volume. In the same way, when the bank pays money as credit or loan to these borrowers, an interest rate is levied. The borrower or the creditor on the loan amount is asked by the bank, when he repays the money to the bank, an extra amount as interest has to be paid to the bank. Understood? So, listen carefully. When the bank pays interest to the depositor, they pay only a small amount. When the bank asks the creditor an interest to be paid along with the principal amount, that rate will be higher. So, the difference between the interest amounts paid by the bank to the depositor and the interest rates being paid by the borrower to the bank becomes the source of income for the banks. That is their profit. the source of income for the banks, which later they count and tell that we have earned this much of profit in this financial year. Is it clear? Yes. So, banks have a good role to play, is it not? They act as a mediator. First role, what is the first role of the bank? Acting as a mediator between depositor and borrower, and trying to gain a source of income from these two people, these two groups of kinds of people as interest. Is it clear? So, money served as a medium of exchange. It held value. It was accepted as a common measure for value of all goods and services that is being exchanged. If notes and coins are one form, the other one was the demand deposits withdrawn using a check, and the depositor and borrower become part of the loan activities of the bank, where bank acts as the mediator, and the difference between the interest that the depositor gets and the borrower pays back to the bank becomes the source of income for any bank. Is that clear? So, the money, as I said, is an owned valuable possession. Now, next topic, when we learn, we will see what is credit and how credit becomes important.